All right, let's dive right into this explainer. Today, we're putting Amphenol stock, you'll see it under the ticker APH, through the ultimate test, the Guru Gauntlet. We're talking about a company that's literally at the bleeding edge of the AI hardware revolution. But the big question is, does its sky-high valuation actually hold up when we run it through the absolute strictest investment frameworks ever created? Let's find out. So here's our roadmap. We'll start with a quick company snapshot, then view the stock through the Buffett and Lynch lenses, followed by the Benjamin Graham lens. After that, we'll crunch the numbers with a DCF valuation model, look at some additional valuation models, and finally wrap it all up with our synthesis and final verdict. Kicking things off with part one, our Amphenol company snapshot, focusing on their connectivity and hypergrowth. Right now, Amphenol's stock price is sitting right around $164.59. And if you're not super familiar with them, they're a massive player in electronic equipment, instruments, and components. Specifically, what's been driving this price action is just this insatiable demand for their fiber optic products, high-tech interconnects, and sensors. And these are absolutely critical must-have hardware pieces for the AI datacom market. And man, this really shows off their momentum. We're looking at a staggering 58% jump in revenue year over year, hitting $7.62 billion in just a single quarter. Now, about 33% of that was pure organic growth, which is incredible on its own. But the rest? Well, that was heavily fueled by the recent massive $10.59 billion cash acquisition of CommScope's connectivity and cable solutions business. So yeah, they're growing fast natively, but they're absolutely buying growth too. Moving right along to part two, evaluating this AI hardware giant through the qualitative lenses of legendary investors, Warren Buffett and Peter Lynch. So, looking at Warren Buffett's criteria first. We all know he loves a wide economic moat, consistent earnings, high margins, and, crucially, manageable debt. Well, Amphenol definitely boasts a massive moat and sky-high demand. Look at their 1.24 book-to-bill ratio. Basically, that means they're getting way more orders than they can even fulfill right now. Add to that super consistent earnings with a 3.48 trailing EPS and an incredible 27.3% adjusted operating margin. But here's where Buffett might pump the brakes. Remember that CommScope deal? Well, Amphenol took on a ton of leverage to fund it, bringing their total debt up to $18.7 billion, or about $14.2 billion net of cash. That is a heavy anchor. Next up, Buffett always looks at owner earnings, essentially the actual cash a business generates that can be returned to its shareholders. Based on Q1's really impressive free cash flow of $831 million, we can approximate their annualized owner earnings at around $3.32 billion. That's a huge checkmark for Buffett. Plus, management actually bought back 1.3 million shares for $178 million this past quarter, which is a great signal that they believe the stock is undervalued. But, being the strict value investor he is, Buffett always demands a margin of safety. Given that massive debt load we just talked about, he'd likely sit on the sidelines and wait for a price closer to $120 before stepping in. All right, let's shift gears and view this through the Peter Lynch lens. To do that, we first need to quickly touch on his absolute favorite metric, the PEG ratio. This is just a stock's price-to-earnings ratio divided by its actual growth rate. Lynch loved this because it tells you point blank if you're overpaying for a company's growth. The very first thing Lynch does is categorize the company. Is it a slow grower, a stalwart, or a fast grower? Well, given the massive AI tailwinds and that amazing 33% organic growth rate we saw earlier, Lynch would absolutely categorize Amphenol as a fast grower, rather than just a steady stalwart. But here is the catch. Amphenol's PEG ratio currently sits at 1.51 based on projected earnings. Lynch generally views anything over 1.0 as, well, a bit pricey. Ideally, he wants a PEG under 1.0 to guarantee he's getting all that growth at a reasonable price. Because of this ratio and the fact that they have super high institutional ownership, which is typical for an S&P 500 giant, Lynch would probably label the stock as a hold. He'd want to see earnings catch up to the price or see that balance sheet debt come way down. Okay, moving on to part three, the Benjamin Graham lens, tapping into the framework from the father of value investing himself. So let's run Graham's defensive checklist for the ultra-conservative investor. Amphenol easily passes on adequate enterprise size and earnings stability. It also passes with flying colors on dividends, boasting a solid 14-year track record of dividend growth. But there is a glaring issue here. It completely fails Graham's valuation tests. He wants a PE under 15, and Amphenol's trailing PE is sitting at a sky-high 47.24. He also wants a price-to-book ratio under 1.5, which Amphenol fails entirely due to the massive premiums they've paid for all those acquisitions. We can also crunch the numbers using Graham's famous intrinsic value formula, which is the square root of 22.5 times EPS times book value per share. Now, Amphenol's tangible book value is heavily clouded by $17.5 billion in goodwill from buyouts like the CommScope deal. But if we put on our analyst hats and assume a generous industry average book value per share of roughly $15 and use their 348 EPS, Graham's formula spits out an intrinsic value of right around $35. What does that mean? It means the father of value investing literally wouldn't touch this stock with a 10-foot pole at its current $164 price tag.
Let's move right into part 4, bringing out the hard math with our discounted cash flow or DCF valuation model. Before we actually build out this model, we have to define our WACC, or weighted average cost of capital. This is the exact rate we use to discount Amphenol's future cash flows back to today's value, which accounts for the risk of both their debt and equity.
To fill in the gaps here, we're making a few analyst assumptions. Step 1, we're starting with that $3.32 billion annualized cash flow and projecting a robust 15% growth rate over the next 5 years, fueled by all those AI data center buildouts. Step 2, we assume a 3% terminal growth rate, which basically means they keep pace with global GDP forever. And step 3, we discount it all back using an assumed WACC of 9%. Okay, looking at our sensitivity table here, our base case DCF yields a fair value of $128.40, with the stock currently trading up at $164.59. This quantitative model is telling us the stock is currently overvalued. That is, unless you believe their terminal growth is going to dramatically exceed our 3% assumption, or you think they can somehow grow cash flows significantly faster than 15% a year.
All right, part 5, we need to pressure test this with some additional valuation models, specifically comparables and a reverse DCF.
Let's look at a comparable PE analysis first. If we use forward earnings estimates of $5.62 per share next year, and we assume the market just keeps awarding Amphenol a premium tech hardware multiple of 35 times forward earnings, we get a pretty bullish price target of around $196.70. However, if we flip the script and do a reverse DCF, which essentially asks, hey, what growth rate is already priced into the stock today, it shows the market is demanding a flawless 21% sustained annual cash flow growth over the next 5 years just to justify today's $164 price. That is a tall order. And finally, part 6, our synthesis and final verdict. Time to bring it all together. This master scorecard is honestly incredibly revealing. Outside of that optimistic forward multiple projection of about $196, all the legendary value frameworks and our own base case DCF suggest the stock is basically priced for perfection. Graham says runaway at $35. Buffett wants a much larger margin of safety near $120. Lynch says hold because the peg is too high, and our DCF model lands at $128.40. So here's our final verdict. The strengths here, they're undeniable. You have unmatched AI datacom demand, incredible 27.3% operating margins, and really seamless execution on massive M&A like that CommScope deal. But we can't ignore the risks. That heavy $18.7 billion debt load is massive. They had a recent non-operating China tax hit affecting their GAAP net income, and they're trading at highly demanding valuation multiples like that 47 times trailing PE. Balancing all of this together, our final recommendation as an analyst today is a hold at $164.59. Now, for those of you looking to get a piece of this fantastic business, patience is absolutely key. Buffett would likely wait to strike somewhere near $120. Lynch, he'd wait for earnings growth to accelerate past the price to push that PEG ratio under 1.0. And Graham, well, honestly, Graham is probably looking for bargains in a completely different sector entirely. As we wrap up this explainer, I want to leave you with this one final thought. When a company like Amphenol so thoroughly dominates a hyper-growth sector like AI datacom, at what point do the old rules of value investing simply stop applying? Are the traditional gurus right to be super cautious here? Or is the market right to just pay a massive premium for a guaranteed winner? Something to think about. Thanks for exploring this with us today, and keep on analyzing.